In this video, I'm going to go over a couple of things that I have noticed that is pervasive through each business cycle and use that to kind of gauge where we are in the current economic cycle of our time post-COVID. So one of the things that has been kind of elusive to economists in general. Now, there are certain schools of thought that have come up with their own ideas and theories about why economies go in cycles where they go through periods of expansion or growth and then go into periods of contraction or recessions or negative growth where the economy actually drops and less goods and services are produced, relatively speaking, to where they were in the previous period. But what I'm going to do is try to transcend that and show you two universal things that happen during the end phase of an expansion of the economy, and then explain why I think those things happen without trying to steer you one way or another to a particular school of economic thought. And one of the things that I've noticed is that in this red line, which represents the producer price index, and this is, to be particular, the specific, this is the growth, the annualized growth rate in the producer price index. So it is the year-over-year change in producer prices. What I have noticed is that during times of the late stages of an economic expansion, you have producer prices steadily increasing here. Usually speaking, not all the time, you will have increasing producer prices. But another characteristic is on the blue line, which represents total debt in the economy. And again, this is the year-over-year change, percentage change in total debt in the economy. What you typically have is either a flat or contraction of credit inside of our economy, or a contraction of the growth rate of credit. So taken together, what this means is that if you have a flat or contractionary growth rate in the credit cycle, in total credit in the economy, combined with rising producer prices, which raises the input cost into business production, it then signals an end of the economy of this economic cycle, because essentially profits are squeezed from higher input cost and businesses are no longer able to expand or increase their productivity through borrowing money through excess credit. So this contraction in the growth rate of credit could also signal a rise in defaults and delinquencies on loans, which means that the more delinquencies and defaults that you get on loans, it marks off the total amount of debt in the economy because it's being liquidated, aka those businesses are going bankrupt. And why are they going bankrupt? Because they're facing higher input costs and are no longer able to borrow their way out of the situation in order to keep themselves afloat. And so then the economy goes into recession, a period where business projects are completely abandoned, or relatively speaking abandoned, and it allows those producer prices to drop, allowing the supply of commodities, raw materials, and resources to increase, so that way they drop in price and then are able to be used again by businesses, along with an expansion in the growth phase of credit, allowing businesses to borrow money from the consumers through the banking system, through saved money, or in our modern era, in the case of expansionary monetary policy, buy and bid up those resources and then use them to produce again, and the economic cycle starts anew. So if you notice here during the 1950s, you can see here that starting in 1956, we started to see a contraction in the growth rate of the credit of total debt in the economy, combined with rising producer prices, and this squeeze that we noticed here signaled the end of the economic expansion and the beginning of the economic recession that started officially in August 1957. When we go into the late 50s, we see here that although producer prices were dropping, look at the growth rate of the credit cycle. So the credit cycle spiked here in quarter 3, 1959, and then it started to taper off and drop while producer prices were flat. This tapering off in the growth rate of credit here signaled to me that businesses, even though producer inputs prices were staying flat, there was some kind of there was some kind of wiping out of business expenses going on earlier, a wiping out of investments, so to say, where businesses have basically, made some bad investments, produced the wrong particular types of goods, or they produced too much. Even faced with flat business costs, they can no longer borrow enough money to keep the operations going, and so we had to abandon those projects in the late 1950s, early 1960s, which then put us into recession. In the mid to late 1960s, we see a classic situation where we have flat growth rates in credit and debt, but we have rising producer prices again, and that squeezed the margins on business, plunging into recession. 1974, 1975 is a severe case of this, where the producer price growth rate actually exceeds the growth rate in debt and credit, and it produced a severe recession in late 1973 and 1974 until producer prices, or at least the growth rate in those producer prices, were able to come down and alleviate those situation. Margins were able to increase, and the growth in the economy was able to resume and recover. We see a similar situation in the 1980s, where high producer price inflation, even though it is met with high credit growth, the credit growth is again flat and slightly declining, but rising producer prices again squeeze those margins. And even though we see producer price growth rates start dropping, it's not enough to alleviate the margin problems here in the early 1980s, and we double dipped into another recession. Probably because even though the growth rate of credit is flat here, there was probably a contraction of the monetary policy of the money supply and high interest rates caused by Paul Volcker's, relatively speaking, more tight monetary policy, which increased interest cost on those businesses. Then in the late 1980s, again, we see falling credit growth rates, but increasing producer prices, relatively speaking, marking the end of that expansionary phase. In the 1990s here, and just give me a second to bear this out, in the 1990s, we see it again. We see rising producer price inflation, falling and flat credit growth, and again, there's a recession in 2001. Similar situation develops in 2008. We have flat credit growth, but then starting around mid to late October of 2006. So late 2006, we see a growth rate in producer prices. And of course, we have the infamous 2008 crash and a situation where producer price inflation actually outgrew credit growth, once again, much like what we saw in the 70s and 80s. And of course, a lot of this had to do with a falling credit growth caused by bankruptcies in the residential mortgage industries. Then, of course, with COVID, we see here that around 2017, 2018, we see producer prices increase along with flat to slightly growing credit growth. But why didn't this cause a recession here? Well, it almost did, in the sense that the flat credit growth almost caused a banking crisis, in the sense that banks found themselves short of liquidity when the Federal Reserve tried to taper asset purchases and actually sell assets back on the market, combined with rising interest rates. But I think another thing that kind of saved our economy from this and allowed us to grow for a period of time before we started experiencing problems is that back in 2015, 2016, we had a huge drop in producer prices year over year, and this kind of lasted for about a couple of years due to the shale oil boom. So what's going on now? Well, quarter two 2021's debt numbers have not come out, but I expect that credit growth will probably increase at about a 10% rate. But look how high producer prices have skyrocketed. They are well above the credit growth rates around this 10% area. The producer price inflation is now at 20% year over year, which is eerily similar to what we saw back in the 1970s when high producer price inflation exceeded credit growth. And so that increased input cost on businesses, and then eventually led to a recession as productivity started to lag. And in the capital goods and manufacturing and construction industries, businesses had to lay off workers and cut back on production because the cost of production was just too high, and they did not have enough access to borrowed funds to cover the cost and keep them afloat to weather out that storm of high inflation. And I think what we're seeing here is a similar situation. But then the question becomes, why haven't we seen a recession yet? Or even though we're seeing some signs of sluggish economic growth, why aren't we seeing the prognostications and the signs that we are going through a contractionary phase in the economy? Well, I think much like what happened in 2015 and 2016, back in 2019 and 2020, we saw a drop in producer prices, which sort of helped alleviate the valve of high input costs, temporarily speaking, from this later period of higher producer price inflation. So when we average out the input cost here, we see that producer prices contracted by 8% year over year starting April 2020, and then peaked at 20% in July, June, and August of 2021. And when we average out those two numbers together over a 2-year period of time, your producer price inflation is really at about 6%. So it's not up above these dangerous levels yet, but if high producer price inflation continues to stay afloat and stay above, even if it regulates and normalizes itself a little bit, it could signal the end of the economic boom, unless if we start seeing an explosion in credit growth and new debt able to keep these business processes going. So I think that, going into 2022, we could be potentially seeing the onset of another economic recession, a deflationary bust, so to say, very similar to what we saw in 2008. And this would be just because producer prices are exceeding credit growth, which of course leads that credit to be generated to lead to bad investments being made. And this of course leads to bankruptcies, which just spirals out of control and leads the whole economy into recession. Guys, that's my take on this. Let me know what your thoughts are on this. If there are anything that I missed or some insights that you'd like to provide, drop a comment below on the video. Make sure you click that like button, hit the subscribe to my channel if you haven't already. Click that notification bell so that way you are automatically notified when I upload a new video. And I'll talk to you guys next time.